Welcome to this video about what is accounting. What is accounting? Accounting is a way to record financial activity based on a framework called Generally Accepted Accounting Principles. That is accounting, essentially. There's a lot more to it, especially about GAAP. But the basic stuff is going to be this idea about like these financial statements. Statement of cash flow, the balance sheet, and the income statement. So like, who cares about these statements? Well, the SEC, for example, like the trade board, like a stock market trade board, whatever, they care because like there's this thing called a 10K or a 10Q, So essentially what a 10K is like something that companies, right? The company or a corporation, if they're going to be listed on the stock market, as in they're going to be a publicly traded company with shares that can be purchased through the secondary market. So like the primary market is like a private company. I'll give you guys an example of a company that was a private company that was traded on the private market, as in like they would have brokers and then they could still trade these shares, so to speak, privately. Okay, so like an example is a company such as SpaceX, right? So like they were being traded privately, but recently they came out on the secondary market as Wall Street, like as in like that's like the U.S. stock market. Okay, so like that's the secondary market, like the public stock market. So like to be on there, you have to go through all of this like regulations. Like there's various reasons why they have these laws and regulations about like the process it takes for these companies to be traded on the secondary market. One of those things is that they need to have like a 10K, as in like, or 10Q, like this like thing that like a financial document that they have to turn into the SEC every quarter. And part of that is going to be like the income statement, the balance sheet, the statement of cash flow. Because they're a public company, they have to publicly disclose like their cash flow in regards to like their operating cash flow, their investing cash flow, and their financing cash flow. So that's why these financial statements are so important. This is like an integral part of accounting, very much. Um, so like how you would create these statements, pretty much. Well, one of the most important things, although not every company necessarily has this, and it's not like it's gonna be like huge deals, but it's cost of goods sold. Um, so like a lot of these companies are like companies that produce goods or services. So like um, they're gonna have cost in regards to like how they're producing this, how they're manufacturing this, and there's a whole bunch of stuff about managerial accounting, based on like, oh yeah, like how are we gonna calculate cost of goods sold? You know, like how do you guys like based off of like what kind of um, process you guys are picking to calculate this, like the manufacturing process? Is it um, job order costing, you know, or is it like a different type of costing method to be able to calculate this cost of goods uh, manufactured? And then, well, that becomes like cost of goods sold once you calculate in like what it costs to sell this good. But like once you get this cost of goods sold, that's gonna be a really big thing for the balance sheet, because like you have to have the cost of goods sold, like how much you guys spend in selling this product, in manufacturing this product, the total cost that it costed to get this product on the market. And then you guys can get, for example, the revenue, the sales, pretty much the total sales, and then you would minus sales with cost of goods sold to get the net income. And like the net income would be used in the statement of cash flow. So like all of these different things sort of like work together, like the balance sheet, the statement of cash flow, income statement. These are like the main important documents for like these companies to put out this 10K or 10Q. But like even if they don't have to do this, like as in like they're not a public company, there's still like uh, a lot of things that a company can do to like balance their books, as well as record financial transactions, pretty much like it's like a debit and credit system. So like for example, like one of the main things that it's gonna center around, like accounting really centers around this one equation, the accounting equation, which is assets equals liabilities plus owner's equity. Okay, so like that equation has to balance assets equals liabilities plus owner's equity. So like the reason why this equation is so important is because like these are companies that have owner equity, as in like they have like it's kind of hard to understand if you guys are like trying to wrap your head around what owner's equity is. It's like um, ownership of a company, like little parts of ownership that you own. You know, like so like there's a percentage or like a share amount that you own of a company, and that's your equity in that company and your ownership within that. That's your equity. If that makes any sense. So like the reason why this equity is important is because that's one of the main, if the main way, other than like for example if there's like a shareholder or an owner that works for the company and they earn a salary at the company, that could be one way they would be able to get money from that. But um, that's not necessarily the case, because like you wouldn't necessarily want that to happen, because you might not get the most qualified people to work at the company. You really want to have the most qualified person for this job. You guys see? But that's one way that it could work out like that. But even if an owner of a company worked at that company, they would still have equity in that company, and they would still be receiving shares of the revenue, of the retained earnings. So like the retained earnings of the company, like after all these deductions or losses, if there's losses, then those losses would also be distributed um, to the owners of based on of how much equity that they own. Okay. So like, if you guys don't know what assets are, and you guys don't know what liabilities are, assets are like very diverse. But like one example of an asset is cash, and like you can just think of assets as like things that like kind of are like things that kind of have like a net positive to it. And liabilities is things like payables, receivables are going to be assets. Receivables, like a really big thing is like an AR and AP, which is accounts receivables and accounts payables. Accounts receivables going to be like credit that you give out to, for example, distributors. Other companies, you guys give credit to those companies like a credit line, and then they sort of like make purchases of their inventory on credit, but so like the cash hasn't actually hit the account. So like it's like an IOU, but it's not necessarily credit, but it could be credit. It's like a type of credit, like a business credit line, and that would increase the accounts receivable for the company that has sold the inventory or whatnot. So it's like now you owe the company. So the company that owes credit is going to have an increase in accounts payable. They have to pay, and like they'll have to collect that. Okay, so like there's a whole bunch of stuff about accounts receivable and accounts payable, but accounts receivable is an example of assets, and accounts payable is an example of liabilities. Okay, but then the important thing is that the assets have to equal the liabilities plus owner's equity. Um, and let's see. That's like some of it. You know, this is like some stuff. Like, there's just so much more than that. Like, dividends is another one. Dividends, you guys have to think like, oh, that's like another way these companies distribute revenue. Like, retained earnings comes out of the dividends. Okay. Uh, the dividends are like these shared, like, and then you could calculate, for example, how they distribute this dividend. For example, they might have non-cash payouts, non-cash payouts of dividends. They might be paying dividends with more dividends, as in like with the more, they might be paying out dividends with more stock. For example, there's just so much stuff here. Like, you guys can, or like, depreciation is a big one. That's like a big thing in accounting as well. Depreciation. How to calculate depreciation. There's a lot of little like specific nuances, and like really, you guys think about like, oh, the journal entry as well as accounts. Like, there's going to be like multiple accounts. Like, there's going to be like a account for this, account for that, account for this, and then like you guys have to write in like this journal entry. For example, like you put the date in, right? Like, it'll be like, oh, June 15th, right? And then you could be like, what kind of account like a description of the transaction, for example, would be like purchased, purchased inventory, right? Like inventory could be like a short-term asset, like a current asset that was purchased not necessarily for investment purposes, but rather to like create income, like a revenue source for the company. And then you guys have to think like, oh, okay, so like this is like a journal entry that you guys can write. That's like a really important thing for accounting is like these journal entries. Okay, so like you guys would have to create two columns for debits and credits. So if you guys, for example, purchased inventory on June 15th, this journal entry would be written in an account. For example, it could be like an inventory account, like it could be like some like one main account. These account pages could like vary depending on the company, but the journal entry is pretty standard, as well as writing in these debits and credits. So for example, if you guys purchased inventory, let's say you guys purchased $100,000 worth of inventory. Okay, so then that means that the credit or the debit goes up, because like for example, if it's like an asset, the debit means that it goes up. If you debit an asset, it goes up. If you credit an asset, it goes down. If you credit a liability, it goes up. So a liability, think about it as credit. So like if you credit more credit, the credit number goes up. So like the liability goes up, and as well as owner's equity, if you credit, it actually goes up as well. So like in this example of this journal entry, um, because it needs to balance. So if you purchased 100K worth of inventory on June 15th, and you have to write in another journal entry to say like, where did this money come from? It came from cash. Okay, so that means that cash went down. So it would be this 100K of cash would be credited. You guys understand? To balance the books. That's like one of the things that's really important about accounting. So like and like, well, those are gonna be like the main thing. Like bookkeeping is a big one. ARAP, for example, like accounts receivable, accounts payables is another big one. Managerial accounting, cost accounting, like people that are really close to like the factory manufacturing pipeline that like calculate these like manufacturing costs, like unit costs of these goods, as well as the material cost, the labor cost, the overhead, the manufacturing overhead, various things to calculate these cost of goods based off of like certain types of costing models. For example, it could be job order costing, it could be unit order costing. Based off of those, that's managerial accounting, cost accounting. That's a big one. But essentially, this is what it is. Like accounting, that's really all it kind of is. There's like a lot more, like it goes more into depth, like how to calculate depreciation, how to like write in specific things in the journal entry, like every single type of financial action, like every single type of financial thing that could possibly happen, like any kind of thing, any kind of action that a company would take financially would be written into the journal a specific way. There's like a specific way to write in all of these different types of financial activities. For example, payroll, like how to write payroll based off of like taxes that you would need to withhold, like how specifically to do that in the journal entry. That's another one. But essentially, that's pretty much it. Like, you guys really need to focus on like GAAP. If you guys like think about accounting, like this is just like a general gist of like it. Like intermediate, it's gonna go more into depth about this and like go into depth and like really talk more about this stuff, as well as like on a more advanced level. But like in like a very like low level, like this is really what accounting is about. It's really based on this framework, GAAP, and like the whole point about GAAP is to be able to record all this financial activity within this framework, and really it's gonna be like tied into the entity of the corporation. Like it's all about like this entity, like this corporation that really does need certain types of financial statements to make sense of like what's going on here, like the cash flow, the balance sheets, the income statements. And like you can, for example, use that to create the 10K or the 10Q. You could also use it to create ratios, liquidity, solvency, profitability. You know, you can use this more like on an analyst level to like use these ratios. But these financial statements are very important because it will allow analysts, for example, to make these ratios, to be able to compare. Like they can do analysis, like horizontal or vertical analysis, based off these ratios, based off these balance sheets, based off these statements of cash flow, these income statements. And I'll have to make more videos about this, like really specifically. We're gonna go into intermediate accounting in a minute, but I just wanted to do a recap real quick about what this is about. There's a lot more coming. If you guys have any questions, you guys can feel free to reach out to me. Thank you.